Hello friends, welcome to this video on operational risk capital requirement under Basel III norms. In this video, I am going to take you through the new standardized approach calculation as recommended by Basel norms and fine-tuned by Reserve Bank of India. While this video will help you to understand operational risk capital requirement in general, let me tell you that Indian Institute of Banking and Finance conducts various examination for bank employees, and this video will also help you prepare for some of the exams which IIBF conducts, for instance risk in financial services and CAIIB exam as well. Having said this, let me start by explaining the concept of operational risk first, which I'm sure many of you are aware. As per the Basel definition, operational risk means risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. Okay, now we have to break this definition and understand this further. So first of all, operational risk is the risk of loss which may arise because a business, an organization, or a bank specifically does not have adequate controls, uh, or the controls have failed around processes, people, and systems. Sometimes operational risk also may arise from external events which are not internal to the bank or to the financial institution. For instance, earthquake, flooding of an area, terrorist attack, all these are examples of external events which are not absolutely in control of the bank. However, processes, people, and systems are something which are broadly controlled by the banking organization. This definition of operational risk includes legal risk. So, if there is any legal risk which may potentially be faced by a banking organization, it's covered under operational risk. However, strategic risks and reputational risks are not part of operational risk. Now, what is the meaning of strategic risk? Strategic risk could mean simply a bank trying to acquire another bank and thereby having inorganic growth, and the strategy around that fails. Reputational risk may arise, as we know, from any loss to the value of brand or business because of some wrong practices being followed or any issue related to the product or service being offered. That could cause the reputational risk to the organization. Now that we have understood the concept of operational risk, what exactly could be the example of operational risk? We'll try to look at that. So, while there are multiple examples of operational risk, I have just kind of listed some of them to help you understand that uh, intentional misreporting of positions that you may be having. For instance, as a trader, for an instance, you are not reporting your positions properly. Any theft by employee, okay, that's something which may create operational risk. Insider trading by employee in an account. Insider trading means trading after having access to unpublished price sensitive information. Any kind of robbery, forgery, check kiting, and damage from computer hacking can also be part of operational risk. So essentially, the idea here is to understand what could potentially be the examples of operational risk which may result into need for capital requirement for operational risk. Now, for those of you who must be wondering what exactly is the capital requirement, let me tell you that whenever a business faces operational risk and a loss arises because of that, that loss needs to be compensated in form of capital. While banks accept deposit and do lending and investments from that deposits, any risk which arises to the bank is not adjusted against deposit. It is actually adjusted against shareholders' capital. So imagine a bank loses X amount of money because of a theft happening, and it is not able to recover that money, then it's a loss that will have to be taken by or borne by the shareholders. That's how we look at the capital requirement under the operational risk, uh, as as far as banks are concerned. Having said that, let me move to the next slide and tell you some of the challenges which could be faced as far as operational risks are concerned. So operational risks are not easily quantifiable. So there is a challenge in measurement of operational risk. For instance, theft by an employee may not exactly provide the extent of loss that a bank may face. The theft need not be always about tangible, you know, assets, or may not be always about something which can be touched and felt. It could be a theft of data, for instance. So what if an employee steals the critical data within an organization and misuses that data? How will I measure the loss that could arise from that? That's difficult to measure, and that's why operational risk measurement becomes uh, challenging. Second aspect that we need to know or have in mind is that the data points for operational risk may not be readily available. You need to actually work if very in a very meticulous way to get the data. Data sets have to be gathered, and the data must be collated, which could be internal as well as external data, to measure the operational risk and its potential impact. Having said that, let me also tell you that many times it may not be possible to exactly quantify the operational risk. I mean, quantification of it is challenging, as I said in the beginning, and now you can have many events, connected events also, where it will be difficult to figure out what exactly is the operational risk loss that would have happened. But that does not mean anyway that we will not measure the operational risk, and that's why Basel guidelines have provided steps to measure operational risk capital requirement. Under the Basel II norms earlier, now we are in the world of Basel III norms, but it's important to understand what were the key aspects of Basel II norms as far as the calculation of operational risk capital was concerned? Because Basel III norms have moved away from these guidelines, and now we have a separate set of calculation methodology which goes into Basel III norms. But let us first look at what exactly is there in the Basel II norms. We'll try to look at this. So the first approach under Basel norm is called as the basic indicator approach, which you can see here. The second approach is the standardized approach, and the third is the advanced measurement approach. So what exactly does this mean? This means that a bank it can opt for three approaches depending upon the size, the nature of the business of the bank, and regulatory permissions. A bank could have gone with either of the three approach: basic indicator approach, standardized approach, or advanced measurement approach. Okay, so this was under the Basel II norms. Let me repeat that as of now we are under the Basel III norms. Okay, having said this, let me show it to you that what exactly was the basic indicator approach. Okay, so capital requirement under basic indicator approach, it is expressed in form of a formula which is listed below, as you can see, and it says that the, uh, the 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 calculation is based on gross income, where gross income is the annual gross income of a bank, were positive over the previous 3 years. So what does this mean? This means that we need to take into consideration the gross income for previous 3 years, which have to be a positive number. So we'll take into account last 3 years income, add them, and arrive at an average of that particular income. Okay, so we have to take into consideration positive income for last 3 years, and what we do is that we multiply this with a alpha of 15%, okay, which is set by the Basel committee. So what does it mean? It means that if average gross income of a bank was say 100 for last 3 years and it was a positive number, 100 multiplied by 15% will give me a capital requirement of 15. So it was very simple. Let me repeat the steps for you. Step 1, get the gross annual income of last 3 years. Gross income of last 3 years. Now average it out, multiply it with 15% and arrive at the capital requirement. So this was the basic indicator approach. We also had the standardized approach in the previous version of Basel, which is Basel II. Under the standardized approach, rather than taking a 15% standard value, the business within a bank was split under 8 heads or bucketed under 8 heads. They were corporate finance, trading and sales, retail and commercial banking, payment and settlement, agency services, asset management, and retail brokerages. Each of these business had their own risk factors demonstrated by beta. So here we are not using any standard method like 15%. Depending upon the nature of the business subunit or subunit of the business, the risk could be applied. Now, if a bank is more into retail banking, the risk factor or the beta factor is only 12% as compared to 15% under the basic indicator approach. So that way it's an improvement, right? So the bank had to put income under various heads, take again 3 years data, multiply it with the respective beta factors and average it out. That is how the standardized approach used to work earlier. We also had the third approach, which is the advanced measurement approach. The most sophisticated and complex option it was under the Basel II. Here the bank had to get the data, okay, based on its own internal models. The data had to be used and the capital charge or the capital requirement had to be calculated. So here the task was most complex because there was no standard regulatory guideline like basic indicator and standardized approach which has to be followed. In this case, the bank had to work on its internal models. The data has to be obtained and then the output had to be arrived. So these were the three approaches earlier. Now these approaches have been replaced by what is called as the standardized approach, and it's the new version of standardized approach which the banks are supposed to follow now. So what is there in the new version of the standardized approach? I will like to explain that to you quickly. So in order to understand the capital requirement under the standardized approach, we need to understand three things. The first thing is the business indicator, which is called as the BI, which is a financial statement based proxy for operational risk. So as I said in the beginning, and I'm repeating it again, if you have to calculate operational risk, you have to use financial statements like we did annual gross income. That is also a proxy. Okay, it's a proxy because it shows that if your income level is this much, then this kind of risk you will have. So we are continuing with that in a way here. The second component is the business indicator component, or BIC as it is called as, which is calculated by multiplying the BI by a set of marginal coefficients, which we'll see going ahead. Okay, which are these marginal coefficients. Then we also have internal loss multiplier, which is scaling factor that is based on a bank's average historical losses and the BIC. So, essentially what we need to know is we need to know three components. What is the BI, what is the BIC, and what is the ILM. These three components, if you know, you can calculate the capital charge. Now let us see what is BI. So BI is arrived at by adding three variables. It's called as ILDC plus SC plus FC. Now you can see the full forms below. ILDC is interest, lease, and dividend component. So when we work on the calculation of business indicator, then we work on these three factors. SC is the service component and FC is the financial component. Now what exactly is interest, lease, and dividend component? Let me give you a little bit of elaboration of this. The detail of it you can find in the various circulars which are there and other documents. So ILDC basically has some of the broad heads, which is interest income. So interest income is the income from loans and advances. Very easy to understand. If the bank is giving any kind of a loan or advance, it will earn interest from that. Assets available for sale. So if a bank has invested in, say, bonds, and it may earn coupon on that, that's also an interest income. Assets held to maturity, trading assets, financial leases, and operating leases. From all these, if a bank is earning interest income, that is part of ILDC. Additionally, any kind of interest expense that bank will make will also be part of ILDC, and you may have to pay interest expense on deposits as a bank, any kind of loan that you have raised by issuing the bond. So the first case of interest income was buying the bonds. Second case is where you have issued the bonds as the capital requirement and you are paying interest on that. Third aspect is the dividend. So dividend also gets considered under this. So under ILDC, we have these three broad components. I have not elaborated all the points here because that would have consumed a lot of time. But what I'm trying to say is that you will get an idea about what exactly is ILDC. Now, what exactly is the service component which is also being considered? So ILDC plus SC plus FC gives us BI as we saw earlier. So we have already looked at ILDC. Now we are looking at SC. So under service component, fee and commission income that a bank will make and the expense that it may have to incur also for any kind of fees that it is paying on the service that it have availed, other operating income and other operating expenses. So broadly, four heads constitute part of SC, the second component. And then we also have FC, which looks at net profit or loss from the trading book and net profits and loss from the banking book. So banks maintain trading book and banking book. Trading book is the book where assets held for transactional purposes are kept. They are not essentially assets which are held till maturity. So they are tradable assets. And banking book has the assets which are typically held till maturity. They are longer duration assets. So any kind of profit or loss that you will have on these assets will also have to be considered as a part of the FC calculation. So under BI, we have these three aspects: ILDC, FC, and SC. Now let us move ahead and look at what exactly is the calculation method for ILDC. So ILDC gets calculated and the formula is listed here. Let me just tell you that when we calculate the ILDC, we take into consideration this formula which is here, in which we are looking at min of ABS, interest income minus interest expense, okay, 2.25 multiplied by interest earning assets. So whatever is the min of this, we will take into consideration. Now what is ABS? So ABS means absolute value of sub-components irrespective of their sign, which could be plus or minus. Okay, now let me explain to you here. If we look at interest income and interest expense, here in the first case, the value should have been minus 500 because interest income is less and interest expense is more. But we have taken the value to be 500. So we have ignored the sign which could be plus or minus. That is what is meant by that particular data. Second example, we have 3,500 minus 3,200, which is anyway positive 300. So we have taken positive 300. Okay. The third case also we have taken positive 400. So this ABS, which is absolute value of subcomponents, is ignoring the sign, which means even if the number comes out to be negative, it takes the value to be positive. We take this 3 years data and average it out, which we were anyway doing in case of standardized approach and basic indicator approach, even in case of the earlier approach. Here also we will average it out. So this is how the ILDC gets calculated, where we either take absolute value of interest minus expense or 2.25 of interest earning asset plus dividend income separately. Okay, and then we arrive at what should be the value that we get here. Okay, so this is what we will take as ILDC value. The SC value is what we take into consideration as max of other operating expense or other operating income and other operating expense plus max of fee income or fee expense. That is what we will take into consideration here. Here we were taking min of the two, here we are taking the max of the two. That is the difference. And then in FC we are taking again absolute value of net P&L trading book, because this trading book can also be negative value. When you make a loss, it will be negative value. Similarly, net PLN or banking book can also be a negative value. So we are ignoring the sign and we are taking it to be the value. So ILDC, SC and FC will get calculated like this and they will be added together. That takes care of the first component, which is BI in the new approach. What is the next component that we have? The next component that we have is the business indicator approach, which is BIC. So how do we calculate the BIC? So BIC is calculated by multiplying the BE with the margin coefficient. So there are three ranges prescribed by RBI. When your business indicator range is less than 8,000 crores, 8,000 crores to 2,40,000 crores. For those who are not from India and will have difficulty in understanding crore, 1 crore is equal to 10 million. Okay, or I can say that 100 crore is equal to a billion. Okay, that's how we can look at this. Okay, so for BIC shall be calculated by multiplying the BI with marginal coefficient. So say if a bank has a BI of 3,50,000 crores, which is what puts the bank here, then how do we calculate the BIC? The BIC that we calculate is given as follows: 8,000 multiplied by 12%. Now this 8,000 is the threshold put by the regulator. 12% is the marginal coefficient, so we multiply this. Then 2,40,000 minus 8,000, because we have already considered 8,000 in the first calculation, multiplied by 15%. 15% here is this component that we should not forget, plus 3,50,000 minus 2,40,000, which is because it's already calculated, and we will get a BIC of 55,560 crores. So there is a bucketing here, which is bucket 1, bucket 2 and bucket 3. Bucket 1 takes into consideration the business indicator up to 8,000 crores, or to be precise 80 billion, and then you have the second range of 8,000 crore to 2,40,000 crores, and then you have 2,40,000 crores or more, right? So we have done this calculation. So we are done with 2, BI, BIC, and now we move to the third part, which is internal loss multiplier. So how do we calculate the internal loss multiplier? Internal loss multiplier is to be calculated in a stepwise manner. So first you take this part of the formula, only this much you solve. Okay, you don't go beyond this. Okay, so 1 plus 15 into sum of operational risk losses per year, okay, divided by BIC, which is already calculated. Okay, now this is something that you will this is something that you will 15 multiplied by this divided by BIC raised to 0.8 as per the regulatory formula. You will arrive at a solution and then add 1 to that. So that's something that will give you the first component of formula. Exponential of 1, which you have here, is taken as 2.7183. That is something which you can consider as a value, which is 2 decimal point here. Okay, 7, 1, 8 and 3. This is the value that you take for exponential. You can try it as a formula in Excel also by writing equal to exp in bracket 1. After you have got this 2.7183 minus this, then you find out the ln, which is the natural log of the value, and you will get the internal loss multiplier. So internal loss multiplier has to be calculated in 3 steps: the step 1, the step 2, and then finally finding out a ln of it, which can be done through ln function in Excel also. You have an inbuilt ln function in Excel. Now that we have understood this, we will arrive at what should be the operational risk capital. So for the banks in bucket 1, which is this bucket having the BI range less than 8,000 crore, and 2 for banks in the bucket 2 and 3 that do not have 5 years of high quality operational risk annual loss data. So if you fall under any of these category, whether either you are falling under bucket 1, which means your BI range is less than 8,000 crore, or you are under 2 and 3, but you do not have very high quality operational risk loss data, then your operational risk capital will be considered as equal to the BIC. It's very simple. So if it's a new bank which has just started operation, or bank which is very small in terms of transaction, then ORC becomes equal to BIC. Now for banks in bucket 2 and 3 having 5 years and above of high quality operational risk loss data, Okay. If you have that kind of a data available, then your ORC gets calculated by considering two factors, which is BIC multiplied by ILM. We have already calculated the BIC part, which you know, and we have also calculated what is called as the ILM. So ILM and BIC together will give me what is called as the operational risk capital. Okay. So we have to understand all significance of all the three variables. BI, how do we calculate BI? BI gets calculated with three components: ILDC plus FC plus SC, which is basically the income that you have under three heads. Okay. Then once you have got the BI data, then you put the bank under one of the bucket, 1, 2 or 3 here. This is as per what RBI has prescribed, which is Reserve Bank of India. If you are into bucket 1, then it's very clear your ORC is equal to BIC. Very simple. BIC calculation we have already seen. If you are bank which is under 2 or 3 but you do not have 5 years of data, then still you use this formula. Otherwise, use the formula ORC is equal to BIC into ILM, which is to be used in cases where you are having more than 5 years of quality data for operational risk loss events. Okay, so this is how you calculate operational risk capital as per the new Basel norms. I hope this video has helped you understand the concept of the new approach. In case you have any challenge or difficulty, do write to me on healthofmywealth@gmail.com. I'm sure you would have liked this video, so I will request you to subscribe to the channel and also request you to like this video and share it with your friends. In case you need any help or you want me to cover anything specifically related to operational risk, do write to me. Thank you for watching. Hope to meet you in some other video soon.